Welcome back, and now for some exciting stuff, just to show you why markets are important and why what we do in finance is all there. Every time I leave you with some thoughts that have nothing to do with the class, and I want to leave you with one thought. Markets are more powerful the more people are able to participate. Markets are not very powerful. They do not create value if people are left out of them. It's just like democracy. And so please keep that at the back of your mind, that a lot of us do not have even the opportunity to participate. But I want to show you how markets work and how they are just the same thing that we have been talking about. I'm going to try to prevent myself from going too long, simply because, this stuff is, we could go on this forever. But I'd encourage you. If you notice, what I have up there is the good old Yahoo Finance. It's finance.yahoo.com, and I'm going to launch it from here. And if you notice, it jumps straight, and I would just quickly browse the top part. If you look across, what is it showing? It's showing Dow Jones, which is the top 30 companies. S&P 500, we spoke about it, I think, a little bit. It's a large portfolio. NASDAQ is another exchange. But notice what's here. 10-year bond. And if it says 10-year bond unqualified, what do you think it's talking about? The government bond. And what is the chances that this bond will be paying a coupon? Pretty high. And the reason is very simple. Coupon paying bonds are much more common than zero coupon bonds. Just for some fun, there's an exchange rate here between the euro and US dollar and the price of gold. Gold fascinates people. It doesn't fascinate me very much because I don't know why its price behaves the way it does, to be honest with you. Okay, what I'm going to do is if you're coming with me, I'm going on the right panel of the site, right for me. And you'll notice there are some currencies. And this class doesn't talk about international finance, but I think that's a topic that is extremely important. And what's listed here are different exchange rates. And at some point, after this fundamental class, if I do get involved in continuing to do online, I want to do international finance. I want to do valuation with a lot of real-world examples, cases, and so on. But I'll talk about that on the last day of class as to how do we go beyond. But just let's scroll down a little bit. There are commodities, which is not in the class, but they are bonds. Now notice right away, you see a 5-year, 10-year, and 30. What do you notice? In the 5-year, 10-year, and 30, the one thing has to be the case. Unless qualified otherwise, it has to be a government bond. So I'm going to now click on more bonds. And if you see, there's a whole table here. And what do you notice? You notice a 3-month bond, treasury, and the word treasury means government. 6-month bond, a 2-year bond, a 3-year bond, a 5-year bond, a 10-year bond, and a 30-year. These are not the only ones, but these are the listed ones. And what is happening to the yield to maturity? It's showing yield to maturity right now, and it's showing yesterday, last week, and so on. So let's stick with the yield right now. It's 0.05 for a 3-month, 0.12 for a 6-month, 0.26 for a 2-year. And by the way, they are all annualized so that you can compare them, right? Otherwise, obviously, a shorter interval will have a lower rate of return, right? But what you notice, even annualized, what's happening? It's almost remarkable, the steady increase in them. Can you see that? Yeah? And what is that over here? Let's go to the right side. The right side has a little graph, and this jumps out at you in whatever country you're in. This is the relationship between the interest rate or yield to maturity built into bond pricing with maturity. So let me just click on it and it will jump out. So this, if you look at this graph, it is showing you how steadily the interest rates and the yield to maturity on a bond is positively related to the horizon. And this tendency, if you dig deeper, this is a tendency, this is not a fact. This tendency all the time pushing upwards is because of two reasons. Long-term bonds are much more volatile than short-term bonds. Compounding. And we do not like that movement. Are you with me? We do not like that movement. So if we don't like the movement, what are we willing to pay? More or less for that bond? We are willing to pay less. And if you are willing to pay less, what does it say about the yield to maturity? Has to be higher. So remember the one thing, yield to maturity goes up, price goes down. The whole thing. So what I'm going to do spend a little bit more time on this just because we are talking about bonds. And when we do stocks next week, I'll come back. But bonds problems are very interesting. So this table we just saw. And look, what are these? US Treasury. Now look, rated municipal. Why are they rated? Because these are issued by municipal governments, local governments, and bonds. And they too are rated because the probability of default is there, built in. Now the question here is, the maturity is increasing and the tendency of the interest rates to increase with maturity is there, right? But what you also notice is something which should be pretty obvious, is that the municipal bonds in the US are taxable, tax exempt, whereas treasuries are taxable. So what you'll notice is everything else the same, that tax thing should come through. But we are not talking, I'm not interested in municipal. I'm much more interested in showing you something which is peculiar to the US, largely. Corporate bonds. And this has been a subject of a lot of pain and a lot of anxiety continuing to be the case. And the reason is there has been a lot of turmoil in the financial markets. So if you notice what's going on is you have ratings, right? So which is the highest rating? AAA. So if you look at all these bonds, what you'll notice is there is a positive relationship. The higher the rating, the more you're willing to pay. And therefore, the return you're willing to get is lower, right? So look at these last three bonds. As the rating goes down, the yield to maturity goes up. And the reason is very simple. The yield to maturity is fixed for all three, right? And why is the maturity is fixed. Why is the yield to maturity going up? Because in order to entice you to buy a low rated bond, and given that you are risk averse and I am risk averse, we are willing to pay less, which means automatically we want a higher return. I told you I'll start talking about risk and return. So this is the relationship between the two typically. One last point, and do it on your own. Go to Yahoo Finance page and do the following, answer the following question for me. Which bond will pay a higher rate of return? A corporate bond or the government bond? As long as I fix what? To be fair, I make them identical in every other respect. So at least make the maturity the same. And you should know the answer. And next time, what we'll do is we'll review very quickly what we did in bond pricing, and we'll start on stocks. And stocks are the most fascinating thing created by humanity. And I want you to also recognize, I will take the opportunity to show you value creation and destruction using stocks. I cannot do that too much with bonds because bonds are boring. You buy bonds only if you know what they're going to pay in the future. And I believe unless we all take risks, we are not going to be able to do good stuff. So risk taking is inherent to value creation. You don't want to take too much risk, but you have to take some risk. So I'll come back to this. I want to remind you, however, please go to the problem sets and assignments. I have built-in assessments here. When I do a problem, I ask you to do it and then do it with you. So I'm not too worried about the video assessments because I think everything I do is with an example and you do it with me or on your own time. What I'm really want to test you on assessments is in your assignments. So please do the assignments. Please redo all the problems. Make sure you got them. You can go back to the video. Take the problem, do it, go back to the video and see if you got it right. See you next time. Have fun.